Every month, millions of people receive a paycheck, and within days, that money disappears into bills, expenses, entertainment, or impulse purchases. But the real difference between those who stay stuck in the paycheck cycle and those who build lasting wealth is not how much they earn, it's what they do with what they earn. Turning income into assets is the cornerstone of financial freedom, and it's not reserved for the rich or the financially gifted. It's a process anyone can follow once they understand how money flows, compounds, and multiplies over time. In this video, we'll walk through the exact steps to transform your paycheck into a portfolio, a living, growing system that builds wealth even when you're not working. You'll learn how to think like an investor, structure your finances like a business, and make every paycheck push you closer to independence. Let's start with the mindset shift. Most people are stuck in what's called the earned income trap. They trade time for money, earn a salary, pay expenses, and repeat the cycle endlessly. But wealth doesn't grow in that loop, it grows when you move from earning money to owning money. Earning pays your bills, owning builds your future. That ownership comes from assets, things that generate income or appreciate in value. Stocks, bonds, index funds, real estate, and even digital assets can all qualify. The first step is understanding cash flow allocation, where every dollar of your paycheck goes. Imagine your income as a river. For most people, that river flows directly into the ocean of expenses, never to return. Your job is to redirect part of that stream into reservoirs, your savings and investment accounts, so that it starts producing more water in the future. A practical framework to follow is the 50-30-20 model, where 50% of your income covers needs, 30% covers wants, and 20% is invested or saved. But if you're serious about building wealth fast, flip that ratio. Make investing your highest priority, not an afterthought. Even 30-40% invested consistently can radically change your financial trajectory within a decade. The next step is automation. The biggest mistake people make is relying on discipline to save. But discipline is unreliable, systems are not. As soon as your paycheck hits, automate transfers into your investment accounts. Treat investing like a fixed expense, not a flexible choice. The same way rent or a mortgage gets paid automatically, your future wealth should too. This approach removes emotion and builds momentum even when motivation fades. Now, let's talk about what to invest in. The foundation of any solid portfolio starts with diversified assets. The simplest starting point is index funds or ETFs. They track the market, cost very little in fees, and have a long-term record of compounding wealth. For example, a low-cost S&P 500 index fund has historically delivered around 7-8% average annual returns after inflation. Over 20 years, that can multiply your invested money 4 to 5 times without you picking a single stock. As your knowledge and capital grow, you can add more layers: dividend stocks for cash flow, bonds for stability, and perhaps real estate or REITs for tangible asset exposure. The key is to balance risk and reward based on your timeline. If you're in your 20s or 30s, you can afford more volatility for higher growth. In your 40s and beyond, you shift toward preservation. But before you invest, you must stabilize your financial base. That means paying off high-interest debt and building a safety net. There's no point earning 8% in the market if you're paying 20% interest on credit cards. Start by eliminating toxic debt, the kind that doesn't generate income, and aim for a 3 to 6 month emergency fund. That cushion ensures you won't have to sell investments when unexpected expenses hit. Next comes the most underappreciated skill in wealth building: budget optimization. Most people don't need to earn more money to invest more, they need to spend more intentionally. Go through your expenses line by line and categorize them: essential, optional, and wasteful. Redirect every dollar of waste toward assets. Remember, every dollar you save and invest isn't just a dollar, it's a worker that earns you more dollars in the future. A $200 dinner today could be worth $1,000 10 years from now if invested wisely. That's how real investors think. Now let's take it a step deeper. How do you actually turn income into assets automatically? The secret lies in structuring your financial pipeline. Here's a simple system used by financially independent individuals. Direct deposit split. Have your paycheck automatically divided into multiple accounts. A portion goes into your checking account for bills, another into a savings account, and a set percentage directly into investment accounts. Many employers and banks allow you to set this up easily. Investment automation. Set recurring transfers to buy ETFs or mutual funds every month, regardless of market conditions. This is known as dollar cost averaging, and it eliminates the stress of timing the market. Asset reinvestment. Reinvest all dividends and interest automatically. Compounding is exponential if your returns start generating their own returns. Annual rebalancing. Once a year, review your portfolio and adjust your asset mix. Rebalancing ensures your risk exposure stays aligned with your goals. Now, let's address something critical: income growth. Your ability to generate income is the seed of your portfolio. The larger the seed, the faster your forest grows. To accelerate wealth creation, focus on developing high-income skills such as coding, design, data analysis, sales, or content creation. Increasing your income doesn't just improve your lifestyle, it multiplies your investing capacity. The key is to increase income while keeping your expenses constant. That difference is your investment power. At this point, you might be wondering, how much should I invest? A good target is to aim for a minimum of 20% of your income, but if you want financial independence within 2 decades, push that to 40% or more. The faster you invest, the sooner your investments start producing cash flow that replaces your paycheck. Speaking of cash flow, this is the stage where your portfolio starts feeding you back. As dividends, interest, or rental income grow, reinvest them. Let your assets produce assets. Eventually, your portfolio will reach the point where it covers your monthly expenses. That's financial independence. The magic isn't in timing or speculation, it's in consistency, automation, and discipline. Now, let's talk about common mistakes to avoid on this journey. Mistake number 1: chasing quick returns. The moment you try to get rich fast, you risk losing everything. Slow, steady compounding always wins over time. Mistake number 2: over-leveraging. Using debt to invest can magnify gains, but it also magnifies losses. Use leverage cautiously and only for assets that generate cash flow. Mistake number 3: ignoring taxes. Taxes can quietly erode your returns. Learn about tax-efficient investment vehicles like retirement accounts or tax-free bonds. Reinvest the tax savings. Mistake number 4: emotional investing. Fear and greed destroy portfolios. Don't sell in panic or chase hype. Stick to your long-term plan. To put everything in perspective, here's a simple example. Let's say you earn $3,000 per month after expenses, and you invest $1,000 consistently. At an average 8% return, after 10 years, you'll have roughly $180,000. After 20 years, that grows to nearly $600,000. After 30 years, over $1.5 million. That's the quiet power of turning income into assets, the kind of compounding most people never experience because they never start. The final step is to think beyond accumulation and move toward wealth sustainability. As your portfolio grows, it's not just about adding more, it's about protecting what you've built. Diversify globally, rebalance regularly, and avoid putting all your wealth in one asset class or country. The world changes, markets evolve, and adaptability keeps your portfolio alive. And always remember, financial independence isn't just a dream for the lucky few. It's the result of consistent, intelligent decisions repeated over time. Every paycheck is an opportunity not just to live, but to build. The faster you learn to convert income into assets, the sooner your portfolio starts paying you back. Before we wrap up, let's make one thing clear: none of this is financial advice. It's educational guidance meant to help you think strategically about your money. Always do your own research, understand your risk tolerance, and consult professionals where necessary. If this video helped you understand how to turn your paycheck into a portfolio, hit the like button, subscribe to Thefinancialcraft, and share this with someone who's still stuck working for money. Because once you make your money work for you, life changes forever.